This is JB John Barr with Coastal Mitigation Partners and Chapter 5, What the Heck is Net Present Value Testing? This is probably going to be the most difficult chapter to try and explain what they're doing behind the scenes. And they're running several different mathematical calculations in regards to what the property is currently worth versus what is owed. So basically I'll break it down like this. Let's say that you were the investor and you lent out $200,000 and you were receiving 1,500, and the market changed and the value of that is now 170. Would you be willing to take a $1,200 a month payment? Is that satisfactory to you, or would you want to sell the property and try to recoup as much as you can? So those are the type of decisions that they're making, and they're basically going to be a positive or a negative, and this is just one of the pieces in the modification. So on this net present value, what they're looking at is this a Fannie Mae Freddie Mac loan, a GSE loan, or a non-GSE loan? If it's a non-Fannie Mae Freddie Mac, I think it's going to be a little bit more challenging based on current market values to try and modify those, especially if you're in an interest-only type of loan or a negative amortization type of loan or an option arm. Those will be a little bit more challenging to try and do the modifications on. Now, the TARP money, the banks did receive a big chunk of that, and what it was designed to do was to go to servicers, because in their decisions, uh, the investors are still receiving the money. Even though you've stopped making payments, the servicers are turning around and they're shelling out money to the investor. And they're calculating that into their net present value test um, to determine whether they're going to grant the modification or not. Now, this is why the upfront pro report is so critical and so awesome, is that we're doing a couple things. We are giving them on their form, a broker price opinion form, what we think current market value is. So you're pleading your case or presenting the case, but you're doing it in statistical data. And you're basically telling them, hey, if I decide to walk away and go into foreclosure, you could be looking at X, let's say a $21,000 loss, versus if you chose to modify my mortgage, you would be looking at a $12,000 loss. So there is a benefit here. There's a positive benefit of modifying over, taking it to auction or foreclosure, and that's why you should be reviewing the modification option. So when you send in your modification paperwork, your hardship letter, your pay stubs, bank statements, tax returns, all of those items, if you had an upfront broker price opinion or value, it would help them discover what you've already discovered through the pro report, that a modification is a very, very good idea. And I may continue this on another module to get into deeper detail.